Hi, this is Nitin Seshadri. Welcome to this video, which is going to be on the subject of futures. The future is one of the simplest derivative instruments. The word derivative means the value of that instrument is derived from some other underlying instrument. In this case, a future means that you have an obligation either to buy or to sell that particular stock or commodity or index at the time of expiry of that particular contract. Think of the future as a contract, a binding contract. If you buy the future, you have to buy the underlying when it expires. If you sell the future of a particular asset class, you will have to sell that particular commodity or stock or index when that particular expiry happens. Okay, this may sound very theoretical, and I don't want to get too much into technical details. You can find all the information you need about what a future is in a number of sources on the net. One of the simplest ones I can recommend is Varsity by Zerodha, which will tell you pretty much what you need to know about a future, right? But simply put, I'll tell you a few things about a future. A future is principally intended to be a hedging instrument, right? It's supposed to be a hedging instrument to protect against a loss of value for a portfolio or a particular stock that you hold, right? It can also be used like a speculative instrument. It can be used to make money very quickly with leverage. Let me explain how this particular thing works. Right? So let us say that you think that the stock markets are going to rise fairly quickly. Let's say you anticipate that the NSE Nifty index, which is trading somewhere in the 26,000 range right now, is going to be, let's say by the end of December, you think it's going to go up by 500 or 600 points, right? Now, obviously, there are two ways to implement that particular strategy in case you want to do it to take advantage of the index rising. The first and most obvious one is to say that I will buy some sort of mutual fund or an exchange traded fund that's linked to that particular index. For example, I can buy Nifty Bs. Right? The problem with that is you can buy only as so much as you have cash available for. Right? The future will allow you to take what's called a leveraged position. Right? For leveraged position means that I need to block only a certain portion of funds to be able to take a bet or take a directional position on a much larger quantity. Okay? And obviously this comes with risks, because along with the potential large profit that you could make, you could also end up with a potentially large loss. So let me give you a concrete example. Today, let's say the Nifty is about 26,000 and odd. The Nifty future for the end of December expiry, it's a contract for the end of December expiry, will be trading somewhere in the region of 26,120, 26,150, in that bracket and range. Why the premium? Because there is a time value for money, right? There is a time value for money, and therefore it will be at a premium. The future will always be at a premium. Usually it will be at a premium. And so if I buy a future at 26,000, let's say 150 for December expiry, then what this will mean is I will make money at the end of December if the Nifty is trading above 26,150. I will lose money if the Nifty is trading below 26,150. Right? It's a very simple instrument, very easy to understand. It's a straight up or down, profit or loss instrument. But I need not wait till the expiry date actually happens. It is entirely possible that I choose to exit that instrument, exit that investment anytime in between the time I buy it. Let's say I buy this on Monday, or let's say I buy it sometime in the last week of November. and let's say that I wait till mid-December and I find the future is already trading at 26,400. Why would it be trading at 26,400? Because maybe by mid-December the Nifty is already at 26,350, for example. In such a case, it may be worth my while to just book my profit and take it home rather than take a chance and waiting for what it will be at the end of December. So I take my profits, sell, and go home happy. However, one thing to keep in mind with a future, unlike that of an option, which I will come to separately, in a future, every day you may have a gain or a loss. That gain or loss needs to be provided in cash. Meaning, suppose you buy and the future is at, let's say, 26,125. The next day the Nifty falls 50 points and you're down, let's say, to 26,075. That 50 points gap in the Nifty needs to be provided for. Also, a future is sold in multiples which are called lots, and one lot is called 75 units of Nifty. So remember, a 50 point drop in Nifty for 75 units, which is one lot. 75 multiplied by 50 is the kind of money that you need to have available with you as cash in your trading account to compensate. If you don't have it, your position will be liquidated, squared, and it's a highly dangerous situation to be in. Right? Conversely, if it goes up 50 rupees, that 50 rupees is available to you, 50 multiplied by 75, available to you in your trading account to book as profits. For various reasons, which I will talk to you about when I talk about options, futures is an area in which I have stopped dealing, and I do not deal, and I do not recommend that you deal. You need to know about it, you need to know what it is and what that involves. The main reason that I don't deal in it is that future is what's called a delta equal to one instrument. Later when we talk about options, we'll talk about what delta is. But simply put, delta is how the value of this instrument changes for every rupee change in the underlying. Right? Simply put, if the NSE Nifty goes up by 50 points, you can expect the future to go up by 50 points. There are some caveats relating to time, but we won't talk about that. So, in other words, the future doesn't give you any place to hide. It's in your face, it's there. If it goes up, it goes up. If it goes down, it goes down. And you get gains, you get losses. And for a person who is unused to the pressure of seeing a red figure mount on your trading screen, it can be a very, very, very dangerous game to play with a future. An unhedged future. We'll talk subsequently about what constitutes hedging, how you can do it, etc. At this juncture, I think I'm not like a person going to spend a lot of time on instructional materials of what a future is and what an option is. I just told you about what it is, just in brief. I would suggest you go through Varsity by Zerodha to understand what a future is and to understand some of the terms future, like what a future premium is, what a backwardation of a future is, what is contango in a future, and various other concepts. I think there are many videos, more than enough videos actually, on what all these concepts are all about, and it will be superfluous on my side to even be talking about them. Suffice it to say, it's the simplest instrument out there. It gives you an obligation to sell or to buy, depending on whether you've bought or you've sold. The other thing that I want to stress is, in the Indian market, there are two types of futures in the stock market. I'm parking commodities aside for the moment. I don't trade in commodities, and I don't recommend you start your trading career by trading in commodities. You can either do a future in the stock market in an index, which there are two main indexes that I'm talking about. One is the NSE Nifty index and the other one is the BSE Sensex. Although there are some other indexes also available to trade, like specifically the Bank Nifty index of the NSE, etc. You can also do specific stocks. You can do buy a future or sell a future in, let's say, Reliance Industries or HDFC Bank or ICICI, Infosys, and so many other things. If you buy or sell a future in a particular stock, Indian stock market rules, and you hold this to expiry of the contract, Indian stock market rules require that that contract be settled by physical delivery, which means that if you've bought a future for Infosys, then you need to buy the amount of shares which is indicated in the contract. If you have sold the future of, let's say, the same Infosys, and you're still holding that future on the expiry of the contract, you better have that many Infosys shares to sell to avoid a serious problem in terms of auctions, penalties, and all the rest of it, right? So this is just intended to be a small introduction to the whole concept of what a future is all about. I will let you go through Varsity by Zerodha for those who don't have a background in futures. So the next video is going to be about options, and I promise I'm going to get very quickly to actual core subjects of how to execute option contracts, how to manage an option position, how to take an option position, how to do risk management, how to do risk mitigation, how to cut your positions in case of trouble, etc. Those are coming up fairly quickly. I don't want to spend a lot of time on theoretical videos on subjects for which there's enough material on the web. Please go through at your own convenience. The next video is going to be about options, buying, selling, and what to do. Thank you for watching.